Welcome. I'm Catherine Magana here with Rachel Ivanovich, Vince Stefano, and Steve Wolf, where we're here to provide you insights on the markets, tax planning, and much more. Today is February 19th, 2026, and it's been interesting since last week to this week. The markets are down a little bit. The Dow Jones is actually down, but it's up for the year. So the Dow Jones year to date as of yesterday's close, and yesterday was February 18th, was 3.33%. The NASDAQ, which was, it's down year to date 2.10, and it's actually down a little bit more from last week to this week. So obviously we're seeing some of the tech and AI stocks go down in value. The the S&P 500 year to date is up 0.52%, slightly down from last week. And the Russell 2000 is actually year to date 7.12. And it's slightly down from last week, but we've seen a little bit of market volatility over the last week. I know Monday was a holiday, so the markets were closed, but we are still seeing some positive numbers in certain sectors or areas year to date. And looking at kind of interest rates, so the one-year CD right now is about 3.75%, and a slight change on the one-year U.S. Treasury. We're actually seeing it at 3.47, so it's come down a little bit from last week. And then mortgage rates have kind of been teetering. I looked at it this morning. Looks like it was 6.18% for 30-year.
Kat, going back to that Treasury, the 10-year, which is what the mortgages are based on, ticked up today because of the jobs numbers that came out and the economic numbers that came out. It's kind of interesting because there's really a tug-of-war between whether we're fighting inflation or whether we're fighting low jobs.
Well, I was interested. I was looking at inflation numbers, and in January it came in at 2.4, and December it was 2.7. So it's actually come down a little bit from last year to this year. But then the COLA, which is the cost of living adjustment from Social Security, they're projecting for 2027, estimating 2.8% for 2027, and this year it's 2.6. So you're right. I mean, there is definitely, it talks about are the Fed's going to cut rates, and I'm now seeing potentially there's only going to be one rate cut this year, but we'll see what happens. And looking at
in a way, it seems to me that there needs to be a mandate again by the Fed. What are they trying to fight? Yeah. Because right now the economy is doing very, very well. Inflation supposedly is only at about 2.3%, which is very close to what they want it to be. The job numbers are slow. And of course, that's one of the issues that they're talking about with AI, with artificial intelligence, is that job numbers are going to come in slow. But we could have a great economy and still have slow job growth.
True. And so obviously we'll see between now and the Fed change if there is going to be any rate cuts or changes. Right now for March, it looks like the probability of a change in March is pretty slim. So there's a 94% chance of no change between now and March, but obviously we'll see what happens. Anything could happen any time and any day, but that's kind of where we're at with some of the
I did see
numbers.
In the minutes of the Fed, the recent Fed, that there are actually a couple of governors that wanted to raise rates because they thought that the economy may overheat. But I don't know who they were. I don't.
Well, GDP is up to, I think it was either 4 or 5%.
Yeah, so
we haven't seen that type of a gross domestic product, which means the economy is really firing on all cylinders. So that is what I think they're worried about. If they lower the rates, that would be an accelerant to the economy. Then you have to worry about inflation. On the other side, you have jobs that are not as plentiful as they have been. So that's kind of the push and pull that's going on between the Fed. And I don't care who the Fed chairman is. Warsh is if he's confirmed, he's only one vote. And so the committee still may say no, even though that's what Trump certainly wants.
So anything new going out there? Let's talk about stocks.
Yeah, it's been it's been a crazy 6 weeks, but I'll tell you, I think investors right now are being hit by event risk. And event risk is really defined as unexpected news that triggers outside swings in the market. And basically you're seeing, overnight headlines or social media posts that are erasing or creating, billions of dollars of market value.
Well, I was going to say, I'm seeing the headline of the crypto winter, and that's been a big thing this last.
And you've got this massive
weeks.
buildup in of our artillery, our military forces on Iran, and the big question is, are we going to attack Iran or not? So I mean, the headlines are kind of keeping the market a little at bay, but on the other side of that, the current bull market is roughly about 6 years old right now, and recent averages are about 9. So we're only 2/3 through a bull market. If you were talking, I think you were talking about the economy. If the economists and some analysts are correct, you could see an American spending boom this year. You're seeing right now a lot of onshoring of capital, which could lead to increased manufacturing, increased job growth. You're seeing fiscal and monetary policy having a big positive impact on the economy. And what's interesting is business investment. You mentioned this. Business investment is outpacing economic growth right now. So I think if you see the economy is growing at 5%, the business investment is even bigger than that. So that may translate into a better economic
Are you
growth.
talking about all the hyperscalers that
I'm talking
are?
about hyperscalers, offshore business people, offshore investments coming in to build manufacturing capabilities and the like.
Well, I heard an economist, and my opinion of economists is
Well.
pretty low, but I heard an economist this morning say, well, so far we haven't seen manufacturing jobs come in over the the first year that Trump's been in office, and I'm thinking, well, wait a minute, you can't just build a manufacturing plant in a day.
Well, that's the thing. You have to. That's why I'm saying you have to build. That's why you're seeing this business investment is outpacing a lot what you're seeing in the economic side. But I think once you get the manufacturing plants built, like you say, you'll start seeing increased job growth nicely. So, because you got to run these plants and all that. So anyway, also Wall Street Journal had something out the other day. The household net worth has increased dramatically, obviously because of the market. But what's interesting is 32% of the entire net worth is in 65 or older, which
What percent is that?
I thought I saw 32% of the overall net worth of the of the market.
I would think it'd be much higher than that.
I thought I saw 32%. But anyway, that's what a number I thought I saw in the Wall Street Journal. But the interesting fact is that the amount of money that's being held by older Americans is incredibly significant. So that was just
Which means that we should become friendly with
old
all
people.
No, we should
with
be friendly.
their kids.
Thank you for finishing my sentence.
Thank you.
Well, it's interesting you bring that up, Vince, because Rachel and I have been doing our Savvy series this month, talking about inheritances and income. Actually, we had a conversation today about income after loss. And so there's a lot of moving parts when it comes with inheritances, whether it be a spouse or a family member. And we're definitely seeing that and are having conversations about that now.
And there's definitely some tax planning that goes
A
along
lot.
with it. And there are a lot of mistakes that you can make, so you want to be talking with your advisors beforehand.
See, I've worked closely with you. We kind of see eye to eye. I know what you're thinking.
Is that why you're finishing my sentences?
But anyway, from a stock market standpoint, recent sell-off in tech stocks, we've reset some valuations. The same thing with software stocks, which have gotten crushed recently. And a lot of them were trading at 6 to 7 times sales. They're now trading at 2 to 3 times. So the same thing is happening in different industries. But what I want to say is whatever type of investor you are, whether you're a value investor, a growth investor, or some flavor in between, AI is going to have a significant impact on a broad range of sectors and subsectors. It's not just technology. It's materials, it's industrials, it's energy, it's retail, it's healthcare. And they're all adopting AI tools and platforms to increase their profitability. So my point to investors right now is take advantage of any market pullback, look at some of these sectors, and buy the best and most innovative companies within the sector. And if you struggle with trying to identify these companies, give me a call. I'll be glad to talk to you about some of these areas. And I'm going to finish with 2 things. Number one, Sentiment drives short-term volatility. Earnings and revenue drive long-term profitability. That's
It's all about earnings, and,
Yeah.
and people need to remember that. You're going to get headlines. When markets are doing great, the headlines are fantastic. When markets start going the other way, the headlines are bad. And the only thing that really matters in the bottom line is are they making money or are they not making money?
And there's headlines all year round, just whether it be wars.
And especially when you're talking about the possibility of going to war, I mean, obviously, I mean that's a big deal. So I think it keeps some investors a little bit nervous and at bay, but it's still just a headline. It's not the bottom line.
Yeah.
So you know what's certain.
Taxes and debt.
Taxes and debt, right?
That was my
man.
point to jump in here. So one of the things I'm seeing with clients, and honestly, a lot of the forms aren't even out yet.
I was going to say, for Schwab, we started seeing some of the taxable ones, but
feel
they're
like-
not even done yet.
I really
still
feel like we're
coming.
getting a really late start this year, but not just tax forms, but the software for a lot of the CPAs. We can't even e-file yet because the forms are still in development, which I think had to do with the government shutdown potentially, which was in December. But yeah, there are a lot of forms that are still being developed. So stay tuned. But one of the things that I talk to clients about this time of year is estimated payments and don't waste a refund. So that IRS and the state, they don't give you interest on any money that you send them. So you don't want to be sending them too much money, and you don't want to pay them too little money. There's a kind of like the sweet spot right there in the middle.
But what if we don't want to really pay them anything?
Well, I don't think anybody really wants to pay them, so that's semantics here. But definitely be working with your advisors to pay in just enough so you're satisfying your safe harbors and not enough so you're getting this gigantic refund. A lot of people like really large refunds, but it doesn't really make sense to get a large refund because, again, you're not getting interest on that refund. So if you are having money withheld from IRA distributions or from some people have withholding on their Social Security or on wages, make sure you're adjusting your withholding. And this is a really good time of year to be doing that as you're finishing up your tax return from last year. And then also make sure if you have investment income or other income that does not have withholding, make sure you're making estimated payments quarterly so you don't get hit with penalties.
What are the penalties if you don't do that? Do you know?
The underpayment penalty is pretty small, but because interest rates have gone up, the interest is quite a bit higher than it was in the past. If you pay late, it's 0.5% per month. So the penalties aren't huge, but I would say any penalty is too much. So be working with your advisors.
That's actually less than what the credit card companies are charging. I just looked at an offer for a new credit card that just came in the mail today. And it said that if you borrowed money from them or if you didn't pay off your bill, the percentage rate that you would pay is 29.9%.
That's
And
outrageous. Wow.
I always thought that there were usury laws, and I don't know how they get around that, but that is just outrageous.
Agree.
When you can go out and borrow money at a bank for, 6, 7, 8% right now, 29%, whew.
Yeah.
Pay off your bill. I guess that's the bottom line too.
Yeah.
So this last week we met with a client that came in and the husband is retiring. He just retired a few months ago, so we're working with them on their financial and retirement plan and their cash flow needs going forward. But he's 69 years old, and we've been working with them for a few years now. And a few years back, they came to us, and at that time, they really didn't have enough to retire. And so he continued to work for a few more years and ended up with a great opportunity with another firm, had some stock options. And so we met with them recently, and they are at a really solid place financially. They have a plan that works, and it was just nice to see also they have peace of mind. And so we have those conversations. Sometimes it's hard, like, oh, you need to work a couple more years. But the reality is we're really proud of them and so happy for them of where they've come and where they're at going forward. So we're helping them kind of navigate through that next phase. And it's just one of those things that's very rewarding for us as advisors to help our clients get to that point.
Well, it's nice to know that we are helping people, and that really makes all of us feel good because that's really what we do. And I think, for those people who've been our clients for a long time, they trust us. They know that, we're out for the best interests. And, if you need to get maybe your own, if anyone needs to get their own portfolio looked at or their plan looked at, we'd be glad to do that. Give us a holler. Again, it's what we do. So anything else going on right now?
I have a question for you.
Sure. What's your
Fear
question?
and greed index.
I got it just before I walked in here, and it's at 38. So 38 is still, it's in the fear category, which means it's gone a little bit more toward the fear than it was. It was right on the I think if I remember right from 2 weeks ago, it was right on the line of between fear and neutral.
Yeah, and last week it was neutral. So, I'm
Well,
not
I guess
surprised.
when you threats of going to war.
Yeah, that has something to do
I
with
think
it.
that has something to do with it, yeah. And the market has been incredibly volatile lately, to the downside more than the upside, so people are relatively nervous.
There you go. All right. Well, anything else going on? All right. Well, I appreciate all of you who are listening and telling all your friends about us. So we appreciate all that. And we will see you next week on Thursday, correct?
Yes.
Next Thursday. Until then, happy investing, everybody.
Thank you.
Please stay tuned for important disclosures. The opinions expressed in this program are for general informational purposes only and are not intended to provide specific advice or recommendations for any individual or on any specific security. It is only intended to provide education about the financial industry. To determine which investments may be appropriate for you, consult your financial advisor prior to investing. Any past performance discussed during this program is no guarantee of future results. Any indices referenced for comparison are unmanaged and cannot be invested into directly. As always, please remember investing involves risk and possible loss of principal capital. Please seek advice from a licensed professional. WWM Financial is a registered investment advisor with the SEC.